All right, this is the stock market, the SPY intermediate view. So when I say intermediate view, it means I'm looking at weekly charts. And generally that's 1 to 3 months that we're looking at, but this is going to take a little longer view than that as we look at the S&P 500. And I'm going to look at it in some different ways. So let's switch over now to the SPY. This is the market monitor. I'm just going to remove that out of here and then take you to the SPY. So this is the stock market, SPY, S&P 500. As many people look at it, with a candlestick chart. People tend to draw lines and trend lines on it. But what's on here is our moving averages that we look at on a weekly chart, which are the 13 and 34 SMA, simple moving average. And the 13, which you can see right over here, often gives you some support in the market or resistance, as you see right here. And our reversal scout really is a reflection of momentum conditions and also helps us with our cycle analysis. And you can see the reversal scout turned negative momentum right over here in January and then gave that big decline right there. Now I'm going to begin to bring in the cycle analysis. I'll show you 2 more versions of this that you can see. So I'm going to go to this chart right over here, and all of a sudden you are seeing us bring in the cycle analysis. So cycle analysis looks at money flows, essentially. That's made up of large dominant cycles and minor cycles in there. You can see this big dominant cycle here and the harmonics with the minor thirds, like music. And you can see the minor 1/3, 2/3, and the third right in there that made that up. This one did the same, 1/3, 2/3, and the third. And when you get down into these areas here where there's a nesting is where these yellow zones are, as you could see on the bottom, which brings you the biggest of the corrections, as you see right in here. So we had projected a bottom right in here, and that was after a 14.4% drop in the SPY. And that we felt it would be rallying up and probably rallying out into late spring. So we had this big sharp rally and then a pullback right in here. This pullback is far away from this low, and this isn't necessarily a negative occurrence, even though the market's selling off here pretty much today, and with the S&Ps now down about 33 points, 3.3 here on the SPY. This is not down all that far. And then we were projecting up here and then some bigger trouble here. But I want you to have a better understanding of how the how not only in the S&P 500, but any way you would use this style of analysis could really help you understand market conditions. And I'm going to go here where I look at this analysis where I'm bringing in actually the projections and what really happened. So when we look at the cycle brackets on the bottom, they essentially are the ideal, as if it went up half the time and down half the time. But that doesn't happen. Actually, this went up about 90% of the time and only fell 10 or 15% of the time. So that is what's called a bullish configuration right in there. And you can see each of these minor cycles, as they're shown right in here, living inside the more dominant cycle. We're making higher highs and higher lows. And that's a bullish condition, and that gets you to keep moving on the upside. Here we're bringing in the stuff off the daily charts, which takes you even the smaller cycle inside of the minor cycles on here, inside of the dominant cycle here. This is where that cycle was bottoming. That's what it looked like as that low came. So where are we right now? Well, this is the next projection. Why is this projecting below this level here? It's because this was a negatively configured cycle. It is lower than where it started. The probabilities are high that the next rally will not achieve the level of the previous one. That means that that area up there at about 480 is not likely to get taken out. Right over here, the 78.6% at 465 would be about the best area that we would expect it to go up to. And this high up here got up to about 462, and then it began to back off. But you can see in here that this really looks like it has the opportunity to keep trying to get up over here all the way out into late May or early June. So we don't expect the big selling that we have in the market to be able to continue. It is more likely that it'll find support somewhere right in here and then begin to move up again after that. So our shorter term analysis has the supports in here. I don't have it on the weekly chart, but we're getting into this having come down about halfway from this rally, and somewhere in here soon it's likely to get a footing and then begin to move up again, or try to, and in what should be a choppy time frame. Then here, this is out in May or out into early June, where it tries one more time up here, depending on how deep of a sell-off this gets. And then you get into this very risky time, that next yellow corrective zone, which likely takes you down quite a bit of a way in here as the next big sell-off comes. The timing for this next cycle trough is September to November. That's way out over here, which should have some very large selling. The ideal versus the projected cycle is what you're looking at in here, because this is the ideal cycle right there, but the projected cycle is where, from basically this distance here to right over here, which is 480 down to about 411 right there, should be pretty similar or worse on the downside, where you lose from whatever peak you have here about 80 points. That probably takes you down to 380 or lower from there in the S&P 500. So normally I do this only a 1 to 3 month view, but because I wanted to show you how this cycle analysis works, I took it out a little further. You see this green note right over there. The period of upside rebound may be a test of the high. It's doubtful, but we believe it's a false rebound, and this is a hook to make people believe that the bull market is alive and that it's likely to move up to new highs. I think the probabilities of that are very, very small. I would make it that the amount of percent that you could get above the high we just made over here is something like 1 to 2%. The declining possibility is between 20 and 30%. That would probably give you at least a 15 to 1 or maybe 30 to 1 risk reward on the downside. You see where the 15% correction is here. Here's the 20% correction, and the major 38.2% fib here around the 380 level. That's really where we think it's going. Remember, this is the formations that we're looking at. That's not the price. This is where it shows up in the price right over here. And you can get a lot of chop in this period right over here, but then the risks really pick up in the summer and into the fall potentially, where you can get some big drops. This period here into May is a period that can fall hard. This period right over here into July is a period that could fall hard also. And then this one out to September through November, all of those. There are a lot of windows for large declines here in the summer and in the fall, especially. So basically intermediate view is a lot of chop in here, potentially try to get up to those highs around 462 again, up to about 465, and ultimately a very large sell-off and a continuation of the bear market that we have seen here. That is the S&P 500 cycle analysis, taking you through the stages. And I hope you learned something. Remember, if you take our cycle analysis workshop that has only 3 days to go, you will learn so much in the 21 modules. So I want to remind you, only through Monday the 18th can you save not only $400, but $500 if you remember or become one at any level. So I wanted to remind you about that.